Welcome to the very first Accounting 657 Accounting for Income Tax video for fall of 2018. So today we're talking about the cash-based method, and we're going to focus on income recognition. We're also going to talk about the accrual-based method as well. So here's what we're going to cover: an overview of the general methods of accounting, and we'll do that really briefly because we don't get a lot of really good guidance. And then we'll discuss some of the limitations on using the cash method. And then we're going to talk about recognition of gross income under both the cash method and the accrual method. Okay, so let's just get started. Section 446. So the 400s are largely the accounting methods and period sections in the Internal Revenue Code. So you'll see quite a bit of business between, say, 440 and 470, 474 in there. So if you're ever looking for rules about recognition for income or deductions, pretty good bet they're going to be in there. So 446 says that taxable income shall be computed under the method of accounting on the basis of which the taxpayer regularly computes his income in keeping his books. So that's pretty great because really that just means that taxable income can be computed in the same way you keep book income. There are exceptions, however, under B, if no method of accounting has been regularly used by the taxpayer, or, and this is the important part, if the method used does not clearly reflect income, then the computation of taxable income shall be made under such method as, in the opinion of the Secretary, does clearly reflect income. So the clear reflection of income rule is critical when it comes to determining the right accounting for tax purposes. And we'll see that that is a sword that is wielded with some power by the IRS. Okay, so permissible methods under 446 says you can use the cash receipts and disbursements method, an accrual method, any other method permitted by this chapter, or any combination of the foregoing methods permitted under regulations. Okay, so really what it boils down to is there's the cash method and the accrual method. There are no other methods permitted by this chapter. You might argue the hybrid method, but the hybrid method is simply using cash for some parts and accrual for other parts, typically inventory. Okay, so there are limitations on the use of the cash method. When you think about it, the cash method is the simpler of the two methods, right? The notion is when you receive cash as income, when you pay it out, it's a deduction. So pretty straightforward. We're going to find that that's not exactly the case. But not everyone can use the cash method. For example, under Code Section 448, a C corporation or a partnership with a partner that is a C corporation or a tax shelter is prohibited from using the cash method. However, if any of those entities are farming or a qualified personal service corporation or a small business, then they are permitted to use the cash method. So think of it as a corporation can't be a cash method taxpayer unless they meet one of these exceptions. Okay, so one of the important ones is the small business, and that's recently been codified in the Tax Cuts and Jobs Act as having average annual gross receipts for the 3 years ending in the prior taxable year of less than 25 million. So one of the others, farming, we're not going to deal with because we just don't have that many farming clients in San Diego. But the other is a qualified personal service corporation. And that's one in the fields of health, law, engineering, architecture, accounting, architectural sciences, and blah, 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 some of these other things. And but more importantly, it must be owned by employees or former employees. So the notion here is a personal service corporation, right? So a doctor who owns his own practice and is providing medical services, health services, that's a qualified personal service corporation, and they are eligible to use the cash method of accounting whether or not they're less than 25 million in gross receipts. Okay. So even when a company is eligible to use the cash method, if you have inventory under the 446 regs, you are in fact required to use the accrual method for your inventory. And there used to be a couple of exceptions under a couple of revenue procedures, but all that got codified into Section 471. And 471 says now if you are under 25 million in gross receipts, you can use the cash method for your inventory also, with the caveat that, again, it must always clearly reflect income. So how using the cash method to account for inventories would clearly reflect income is a little bit debatable. But there are two safe harbors. The first is if you treat inventory as non-incidental materials or supplies. So there's a specific accounting in the regs under 162 about how to account for materials and supplies. And there are two categories: incidental materials and supplies and non-incidental. Non-incidental are ones that you actually keep track of in your books and records. The second loophole, or not loophole, but the second way you can have a safe harbor is if it conforms to what you have in your applicable financial statements and books and records. So, for example, if you write all those items off for your books and records in your financial statements, then you can presume that that clearly reflects income under the safe harbor. So the accounting for non-incidental materials and supplies is that they're generally deductible in the tax year in which they're first used in operations or, in fact, are consumed in operations. So the idea is at the first time you use them, you get to write them all off. So that's, in theory, a little easier than having to account through them through inventory. So these are simplifying methods. And the Tax Cuts and Jobs Act encouraged a number of simplifying methods, especially when it comes to accounting methods. Okay, so now let's talk. Now that we understand cash, I'm not going to get into the accrual method because the reality is we're familiar with the accrual method. But the general rule for income recognition is that income shall be included, or an item shall be included in the gross income for the taxable year in which it is received by the taxpayer. Okay, so if you receive income, you're to recognize it, unless under the method used in computing taxable income, such amount is properly accounted for as of a different period. Okay, so you're supposed to include it in income when you receive it, unless the method used to compute taxable income says to account for it in some other period. And I view that as that's basically useless. That really doesn't help us at all. Because that's like saying, well, you should include it in the year you receive it unless you're supposed to include it in a different year. Oh, thanks. Appreciate that. So maybe the regs are here for some help. So income should be included in gross income for the taxable year which is actually or constructively received. Again, unless includable in a different year. So maybe a little bit of help, but not really enough. So, but it does invoke this idea of constructive receipt. So under the regs under 451-2, you will have constructively received income when it's credited to your account, set apart for you, or otherwise made available to draw on, or you could have drawn upon it if notice had been given. So what this means is constructive receipt is easier to get to than actual receipt, right? In which case it was actually reduced to your possession. However, it is not constructively received if control of that, whatever it is, property, cash, services, whatever, are subject to substantial limitation. Okay, so if there are any substantial limitations, it is not constructively received. If it is indefinite in amount, or if, for example, the payer has no funds with which to pay. Those are substantial limitations. And then the other thing is you cannot turn your back on income. Control is a key factor when it comes to constructive receipt. Okay, now let's take a look at the accrual method for recognizing income. So under the accrual method of accounting, income is includable when all the events have occurred which fix the right to receive such income and the amount can be determined with reasonable accuracy. And this is in the tax nomenclature, this is traditionally known as the all events test. So when do you pass the all events test? When all the events have occurred which fix the right to receive the income, and it can be determined with reasonable accuracy. So I definitely understand determined with reasonable accuracy, right? So that means you can reasonably estimate the amount. What does it mean to have all the events have occurred which fix the right to receive the income? Well, that's been construed to mean all the rights have occurred at the earliest of. The income is earned. So the income being earned, that is traditionally what you would think of kind of under GAAP accounting, right? If you've earned the revenue, then yeah, you fix the right to receive it, and as a result, that's includable in gross income. The payment is due means that you've earned it, and the payment is due that it just hasn't been paid to you yet. And the last one is the payment is received. And there's something called the claim of right doctrine that can control that, which says, well, wait, if it's just a deposit, that's not income. But if it's anything short of a deposit, to the extent you have received it, under the tax rules, under the all events test, that is income. Which means if you receive prepaid income, it's income for tax purposes. And basically, we don't really like that rule. So let's take a quick look why. So you buy a Cheesecake Factory gift card for your friend in the holidays in 2017. But your friend waits until 2019 to go to the Cheesecake Factory, and then he or she pays with the gift card that you gave them. So what would the book accounting look like? Well, in 2017, when you purchased that gift card, Cheesecake Factory would debit cash, right? So for whatever you gave them, and they would credit deferred or unearned revenue, right? So what's happened is they have an unearned revenue account that is waiting for that to be presented against with the gift card itself. Since nothing happened in 2018, there's no entry in 2018. And then in 2019, what happens is they would now debit unearned revenue and credit the revenue account because, in fact, they have converted that unearned revenue into revenue because you've presented the gift card, or your friend has presented the gift card and paid. And of course, underlying that would also be an entry for the cost of goods sold, right? So there would be a cost entry for whatever it is the Cheesecake Factory sold to you. Okay. So when you think about this under the tax rules, under the all events test, what would happen is in 2017, they would debit the cash just like they did for book accounting, but they credit revenue. That's gross income, right? Because you've met the all events test, the amount has been paid. And then in 2019, when your friend comes in and presents the gift card, that's when they would book the cost of goods sold and, get rid of the inventory and the labor and all the other things. So you can see what that does is that presents terrible matching, right? And so no accountant who's ever worn the green visor would be willing to accept accounting like that. And so the tax rules, even though the all events test is pretty clear, that's the income recognition rule, have created an exception, right? So no surprise there, the tax code has an exception. And for years, it was under the regulations to Code Section 451 and under Revenue Procedure 2004-34. So if you ever see those referenced in any of the materials, know that those were a bit of the gold standard for deferring the recognition of what they call advance payments. So, but now that's been codified under Code Section 451 under the Tax Cuts and Jobs Act. And it also tweaked the rules just a little bit. And it said, look, if you receive an advance payment, which is a payment that you receive for income that's going to be earned in a later period, then you may now defer that income and never any later than when it's recognized for books. So if you recognize it for books, you always have to recognize it for tax, but you can defer it for up to 1 year. So if we think about our Cheesecake Factory example, in fact, let's flip back, right? So we look at the book accounting, we would basically get to mirror the tax accounting in 2017. The tax accounting would be, well, we debit cash, credit deferred revenue. We refer to that as to a deferred advance payment. And then in 2018, because we've made it to the second year, even though for book purposes we don't have to recognize anything, for tax purposes we would in fact have to recognize that into gross income because we can only get a 1-year deferral. Okay, let's do one more example of what this looks like. So here we have an example. In 2018, Arnold receives 4,800 advance payments for a 1-year contract to provide 48 dance lessons. So think of that as $100 a lesson. Arnold provides 8 lessons in 2018 and then the remaining 40 in 2019. So when you think about it for book purposes, he's going to recognize 1/6 of the revenue, or 8 out of 48. If Arnold chooses to defer under the advance payment deferral election, how much would he have to include in 2018 and 19? Well, in 2018, he clearly is able to defer, except he has to recognize whatever he would recognize on his financial statements. Since he recognizes 1/6 of that revenue in his financial statements, he needs to recognize $800. In 2019, it almost doesn't matter what he does on his books because he is required for tax purposes to recognize the entire remaining deferral, or the remaining $4,000. Okay, now let's change that just a bit and tweak it and say, okay, it's the same facts except now it's 96 lessons over 3 years. So he would recognize 1/12 in 2018 for book purposes, right? So that's 8 out of the 96. 6/12 in 2019, so that's pro rata, kind of X number of lessons per month. And then the remaining 5/12 in 2020 for book purposes. So think of it as he's basically recognizing it pro rata over the time in which he's delivering the services. So, however, for tax purposes, he would recognize the same 1/12 in 2018. He would be eligible to defer the remaining. However, in 2019, which is the year after the advance payment was received, for tax purposes, he would be required to recognize the entire remaining 11/12, which means that we end up with a book tax difference in the second year, but we also end up with a book tax difference in the third year. Because what happens in the third year is that he recognizes income for book purposes, but he recognizes none for tax purposes. Okay, so if we were to give this a quick summary, the all events test is what applies to accrual-based taxpayers. And we know it's the earlier of earned, due, or received. That causes bad matching. So 451C permits at most a 1-year deferral. Oh, excuse me. See, I'm tired of listening to myself talk about accrual-based accounting. But you have to recognize it never later than you did for book purposes. Okay, and amazingly, that brings us to the end of today's 657 video. Thanks for watching.